Good morning. I'm Nick Stern with Robert L. Stern Financial Services. I'm a certified financial planner. Thank you so much for tuning in. Really appreciate it. For those of you new to the topic discussions, welcome. And for those of you who have joined me for the past year and a half or so, welcome back. So, getting right into it, for July's topic discussion, I wanted to briefly discuss all the different types of retirement plans that you might have available to you depending on whether or not you're a business owner, depending on the type of income you receive, etc. I think this is important because a lot of employers have stopped offering retirement plans, or smaller employers don't have anything, and it's important that if you don't and you're making the means where you have available income to start contributing to a retirement plan, you should be, because it's all about the time that you have now, time investing, of course, which we've talked about last year, so that you have a nice little sum of money, or large sum of money, hopefully, at the end when you eventually want to stop working. And I think it's probably a little bit funny to talk about retirement considering it's 30, 35, 40 years off for some of us, but nonetheless, we have the time available now to begin those contributions. And what's nice is we don't have to make a great deal of money or large contribution amounts in order to make a difference 30 years from now or 40 years from now. So that's the premise of it, and that's why it's important. So, number one, you have your 401k. Most people are familiar with that. We're going to talk about some things that aren't maybe as familiar when you don't have a retirement plan or 401k plan at work. So if you're working for a small business owner and you really like your job and everything's going well, that's great, really. But it's important that you start thinking about bigger picture finances, one of which would be a retirement plan. So a couple options that you might have, depending on your income limits: a traditional individual retirement account, or IRA, or a Roth individual retirement account, or a Roth IRA. The difference between the two is the traditional IRA, you make monthly, annually, semi-annually contributions into that, up to $5,500 for the year, as long as you're under the age of 50. And that money that you put in is tax deductible now. The funds in there grow tax deferred, and then when you take it out at age 59 and a half or beyond, that's when you're going to get taxed. So there's an immediate tax benefit right now, which is really nice for most of us, because if you're right on the fence of a certain income tax bracket, this might actually be able to reduce you into that lower income tax bracket. Then you have what's called the Roth IRA, and that's what's called an after-tax IRA. There is no immediate tax benefit. However, all the contributions that you make grow tax-free, and after age 59 and a half or beyond, that's when you can start taking it out, and that's when you'll receive actually tax-free income. So even if you do have a retirement plan at work, and that's pre-tax, or in the traditional sense, like a traditional IRA, maybe it would make sense to open up a Roth so that you have after-tax monies. Both of these are your very basic and pivotal things in your overall financial picture when planning for retirement. In fact, even if you have a 401k, some people choose to contribute additionally outside that 401k, depending on income and depending on how much they're actually contributing into their retirement plan through work. Now, there's other retirement plans at work that you might be familiar with, or maybe even you have one at work, which is one might be a savings incentive match plan for employees, aka a simple plan that works similar to a 401k, except the limits are lower and there's some other different IRS requirements and less flexibility in how it's structured. But what's nice about that is the employer, if you put in money, is required to match up to 3%. There can be some variations in how much they're required to do in a 5-year timeline, but you would be notified of that. If you're a self-employed individual and you have no employees, what you might want to consider is a SEP IRA, otherwise known as a simplified employer pension IRA. Similar, it works as a traditional IRA, except the limit or the maximum amount that you can put in is much greater. The reason why I say if you have any employees, that's an important factor, because based off recent rulings with a SEP IRA, you would actually have to, if you open one up for yourself, you would also be required to open up one for your employees, which would be very nice for the employees, but it's only nice if you're able to actually do it. But what's nice about the SEP IRA is, again, you can put a lot more money in over the amount of $5,500. Your accountant, when you file at the end of the year, can let you know what your contribution is or what you're able to do. But again, that's a really nice feature, particularly if you're doing really well and you want to take an immediate income tax shelter, where it's similar to where it works in the traditional IRA, gross tax deferred, and then when you take it out, that's when you get taxed at age 59 and a half or beyond. So those are a couple of the various retirement plans that you have available. I would certainly recommend that if you're not contributing at work, find out if you have a retirement plan at work. If you have one, start contributing to it, or at least understand the benefits of doing that and assess whether or not you can actually afford it. If you don't have a retirement plan at work, take a look at the Roth IRA and the traditional IRA. There are some income limitations within the Roth IRA, meaning if you make over a certain amount, which is for 2015 $120,000 to $130,000 if you're single, and if you're married between $180,000 and $190,000, you will get what's called phased out, and you'll no longer be eligible to do that. With the traditional IRA, there's no income limitations. Same thing with the SEP IRA, there's no income limitations. Another important piece is, when looking at all the various options, figure out whether or not you like that after-tax feature or that pre-tax feature, and what's really going to suit your needs. But when you're assessing your needs and goals, don't just think about right now, today. Think about now and big picture, meaning long term, to determine whether or not you want to have potentially some after-tax income or what other sources of retirement income you might have. That being said, thank you so much for tuning in. There's contact information on the bottom of the screen. It'll frequent throughout this video, as you've seen. No obligation. We're here to answer any questions. Really appreciate your time, and I look forward to seeing you in August. Thank you.